Hello everyone, I'm Quan Ray. Welcome back to the channel. So in today's episode, I'll be talking about mainly two different portions. First of all, it'll be on the earnings that have come out so far. And second of all, it'll be on your AI chip industry as well as the entire ecosystem. Okay, so first of all, let's talk about Honeywell. So Honeywell actually reported earnings. These were their earnings that came out, and it was underwhelming on the surface. So if you look at, for example, the aerospace technologies revenue growth, it was low single digits, and then building automation is double digit, but organic revenue growth, which are these segments here, were quite underwhelming by the management team. So I actually listened to the earnings call as well, and this is what management said. They basically said that in the aerospace division, they actually faced some form of a supply chain headwind. So it wasn't anything structural, it was more of a transitory problem. So if you look at this graphic over here in January as well as in February, they had lower than expected output growth relative to March and in Q2, Q3, and Q4. So management said this is transitory, is not really an issue, and that's why Q1 in aerospace looked a lot weaker than what it was expected. I actually forecasted aerospace to grow at high single digits over the next few years. So we have to see if management is able to keep up with this expectation moving forward. As for the other business segments, management basically said that it was hurt because of your Middle East conflict. So they expect around 1% impact in Q2, and they actually lowered the guidance as well for their operating cash flow number. And that was why the stock actually fell by around 2% yesterday. I think for Honeywell, the main thing to look out for would be the spin-off that's coming up in July of this year. So the second company that I'll be talking about is GE Aerospace as well as Safran. So GE Aerospace reported earnings a few days ago before Safran. And what actually happened after the earnings report was that the stock fell by around 6%. And then the second day, the stock actually fell by around 3% again. And the reason why the stock fell wasn't because the earnings were disappointing. It was probably because the markets were expecting too much or the valuation was a bit too high. So in the case of GE, they actually reported amazing earnings. So if you look at the revenue growth, for example, the order growth, all the numbers were great. But the reason why the stock sold off was actually because of this. So they were basically forecasting for macro conditions to worsen or to be bad in the next few quarters. So for example, over here, they said your Middle East departures will be low single digit down in 2026, and your global departures went from mid-single digit up to low single digit to flat for this year. So this actually had a ripple effect to Safran. Safran, despite having a lower valuation than GE, also sold off on the same day. And after Safran's report, the stock continued to sell off. So in the case of Safran, the earnings were incredible as well. So for example, this is the propulsion revenue. It went up by around 33.1%. And all the other segments are also doing very well. Revenue was up around 23% for this quarter. So it was actually nothing to do with the company itself. The company is structurally very strong. There isn't any pull forward demand. And what Safran's management team also said is that they have been very conservative in terms of the outlook, in terms of their guidance, which ties back to my thesis of the company's management being a bit conservative on their projections of shop visits over the next few years. So just to recap on my thesis of Safran is that the company is being conservative about their shop visit numbers over the next few years. So shop visits, you have CFM engines and you have LEAP engines. Currently, CFM engines are the ones that is profitable. LEAP engines are not so profitable yet. They just turned profitable last year. And in the case of Safran, I think management is under-guiding the shop visits over the next few years, because for shop visits, what you can do is you can look back to the aircrafts that were delivered maybe 8 years ago, 14 years ago, and 22 years ago. And if you look at those delivery numbers, if you have to model it out, it looks like it's going to pick out in 2030, 2032. And that's where I think the management is under-guiding. So for Safran, I think at today's valuation, the company is trading at, I believe, around 25 times price to free cash flow, price to forward free cash flow. In terms of the price to earnings, I think it's around 26 to 27 times now. So for this company that is growing decently strong at around 20%, I don't expect this 20% growth to continue on and on and on for the next few years. But based on my model projections and based on what I feel about the company, based on my thesis, I think Safran is a great company, and I've actually added to my position after this earnings report and after the stock fell. Okay, so this piece of news is a teaser for the next part. So the next part will be on Jensen Huang's interview with Patel. I think a lot of people have missed out on that interview and the implications of whatever he said on that interview. But just to come here, this is the White House saying that China is actually a threat in terms of US AI. So this actually came out yesterday, and I think there may be implications on some of the AI stocks that you currently might hold. In my case, I've been trimming down my ASML positions quite aggressively over the past few months. So I trimmed at 1,003, 1,004, and I plan to trim again at 1,005. In the case of ASML, it's a high quality business, but valuations are very overstretched. At 50 times earnings, if AI demand continues growing at 20%, it probably justifies the valuation over a 10-year period, but I don't think most companies can grow at that rate for a long period of time. So yeah, this adds on to it as well. So if your White House comes in and imposes restriction on companies and forces other countries, like for example, the Dutch, to impose similar restrictions as well, and you could see ASML's China division being stripped away and the company's revenue basically falling overnight. So that's a heads up with this piece of news. Let's look at the more important one, which is Jensen Huang's interview with Patel. So he actually made this interview, I think he was a bit agitated throughout the interview because he was actually being challenged for once. And this particular instant is one that I feel is extremely important. So Patel basically asked Jensen why Jensen doesn't want to become a hyperscaler himself with NVIDIA.
So the question still arises, okay, well, now that we're here, and you have all this money that you keep making, what should NVIDIA be doing with it? And there's one answer which says, look, there's this whole middleman ecosystem that has popped up for converting CapEx into OpEx for these labs so that they can rent compute. Because the chips are really expensive. They make a lot of money over their lifetime because the AI models are getting better. The value that they generate through tokens is increasing, but they're expensive to set up. NVIDIA has the money to do the CapEx. So, and in fact, it's been reported you're backstopping CoreWeave up to 6.3 billion and have invested 2B. But yeah, why doesn't NVIDIA become a cloud themselves? Why doesn't it become a hyperscaler themselves and rent this compute out? You have all this cash to do it.
This is a philosophy of the company, and I think it's wise. We should do as much as needed, as little as possible. And what that means is the work that we do with building our computing platform, if we don't do it, I genuinely believe it doesn't get done. If we didn't take the risk that we take, if we didn't build NVLink the way we built, if we didn't build the whole stack, if we didn't create the ecosystem the way we did it, if we didn't dedicate ourselves to 20 years of CUDA while losing money most of that time, if we didn't do it, nobody else would have done it. If we didn't create all of the CUDA-X libraries so that they're all domain specific, this is a decade and a half ago, we pushed into domain-specific libraries because we realized that if we didn't create these domain-specific libraries, whether it's for ray tracing or image generation or even the early works of AI, these models, if we didn't create them for data processing, structured data processing, or vector data processing, if we didn't create them, nobody would. And I am completely certain of that. We created a library for computational lithography called cuLitho. If we didn't create it, nobody would have. And so accelerated computing wouldn't advance the way it has if we didn't do what we did. And so we should do that. We should dedicate our company, all of our might, wholeheartedly to go do that. However, the world has lots of clouds. If I didn't do it, somebody show up. And so following the recipe, the philosophy of doing as much as needed, but as little as possible, that philosophy exists in our company today. And everything I do it with that lens. In the case of clouds, if we didn't support CoreWeave to exist, these neo clouds, these AI clouds wouldn't exist. If we didn't help CoreWeave exist, they would not exist. If we didn't support Nscale, they wouldn't be where they are today. If we didn't support Nebius, they wouldn't be what they are today. Now they're doing fantastically. Is that a business model where? No. We should do as much as needed, as little as possible. And so we invest in our ecosystem because I want our ecosystem to thrive. And I want I want the architecture and I want AI to be able to connect with as many industries as possible, as many countries as possible, and make it possible for, the planet to be built on AI and to be built on the American tech stack. And so that vision, I think, is exactly what we're pursuing. Now, one of the things that you mentioned, there are so many great, amazing foundation model companies, and we try to invest in all of them. And this is another thing that we do. We don't pick winners, and we need to support everyone, and it's part of our joy of doing so.
Here are some of my thoughts on what he basically just said. So this is what Jensen Huang said. Patel asked him why NVIDIA isn't going to become a hyperscaler on its own. So use the chips, build the infrastructure, rent the compute. And Jensen Huang went on to make basically like a marketing speech talking about if they didn't do it, then no one else would have done it and so on. And if you listen to the very end of it, this is what he actually said. So he talked about CoreWeave, he talked about Nubia as well. And he is basically saying that if NVIDIA didn't supply all these companies with the chip, then all these companies wouldn't exist. I find this quite ridiculous. Basically, if you think about it, he is investing in all the different companies for them to buy chips from NVIDIA. So it's like a circulated manufactured demand in the case of all the different neo clouds. And if you listen to the interview as well, he also mentioned something else, which was with respect to Taiwan Semiconductor. So he went down to Taiwan, he got them to basically increase the supply. He talked to the management team there, told them a story, and then told them to basically increase the supply for the chips, to build up more infrastructure so that they can make more chips, so that they can make more NVIDIA chips. So I think NVIDIA in its current position, it's a pretty dominant position. What they're basically doing is they're managing demand. So they're investing in new cloud so that there is still demand, they're manufacturing demand. And then they're also managing supply quite well. They're making sure that TSMC is able to supply whatever is needed. But I think the problem herein lies, is this sustainable? So the streets have been expecting NVIDIA to beat and raise for over 2 to 3 years already. And can this go on? The company is already so big. Can they continue having this demand that is endless? So you have alternatives now coming up. For example, you have your ASICs. So for example, you have your TPUs, you have your Trainium from Amazon, for instance, as well, which are much lower in terms of cost. And I think in the case of NVIDIA, I feel a lot of the market participants are basically ignoring this. The company is in a dangerous position where expectations are sky high, everyone expects it to beat and beat and beat, but at the same time, it is manufacturing the demand for the products that they sell, which is not exactly healthy. So for example, Patel also said in the interview that NVIDIA has billions and billions of dollars in accounts receivable. Basically, they're selling chips on credit rather than collecting the cash. So that's another issue as well. So I don't want to go into the debate on whether or not it's a bubble, but I think NVIDIA is in a pretty precarious situation on itself. It's manufacturing demand, it's controlling both supply as well as demand. It's the intermediary, which is what you typically want for a company. But at the same time, if you're investing into startup companies to get them to buy your chips, it is not exactly healthy in the long run as well. So I think this interview actually shed light on a lot of the different aspects that most people are missing today. Check out the interview if you're interested. I hope you guys have found this video useful, and I'll see you soon.